In the near term, Mark Newton, who is the chief technician over at Greywolf Equities, is somewhat bullish. He's cautiously bullish. But what we're talking about is these huge equity inflows and what that can mean for the market. So let's talk about the short term, and then let's go to that bigger picture. Short term, you're feeling that you can't fight the tape.
Well, it is difficult to fight the tape. Look, I mean, we've been up 15 to 20% or so over the last few months. It's been difficult. Ever since the November lows, the market's up at least 10.5%. Everybody's trying to pick spots, saying this is the best spot to potentially get out of stocks to get short. Markets are clearly overbought. You have almost 81% right now of NYSE stocks above their 200-day moving average. You've started to see waning momentum, and over the last couple of years, this is something I think we've touched on before, gradually as the market goes higher and higher, momentum is getting weaker and weaker. It's having a tougher time confirming these highs. Volume has been an obvious concern. This is natural after two of the biggest bear markets we've seen over the last 15 years, that people just don't still have an interest in investing here. Even though stocks seem cheap, there's still a lot of issues that are keeping people on the sidelines. Sentiment, however, has gotten a lot more bullish. If you look at the spread between bulls and bears, it's up at 30%. It's one of the highest levels we've seen in the last year. Historically, when you see levels like this, oftentimes it does correlate with market peaks.
Well, that's what we were just talking about, is we have seen huge equity inflows in the billions in January and even going into February. And you were pointing out, well, we've seen this before and it's not been good.
Yeah, I don't always look at that as being a positive indicator. I mean, people think in the long term, yes, inflows for stocks are good. However, the last time we saw big inflows like this was 2008, and obviously that was a horrific year for stocks. And also in 2000, February, March of 2000, we saw one of the biggest inflows on record. And of course, stocks peaked at the end of March of 2000. So it's tough to look at that and saying, okay, now we can feel at ease because money is flowing back into stocks. I tend to think that people are still very much on the sidelines with regards to institutional investors. And as we continue to mention this Dow 14,000, that's slowly getting people that are not involved with stocks and lulling them into a false sense of complacency, which I think at this stage of the rally, it's a time to be a little bit more cautious after this run we've had. We're up against pretty significant levels.
All right, so short term, really short term, 3 to 5 days, you're bullish, but long term, a little more cautious.
That's right. I mean, the S&P up at these levels. Intermarket divergence is something we should touch on because, yes, the Dow Jones Transportation is at new highs, the Russell 2000 is at new highs. However, the Dow is certainly not. The NASDAQ 100 is nowhere near new highs. So you have this level where some indices have moved up, some haven't confirmed, and that's going to be important to monitor going ahead. So S&P up near current levels, 1525 for me is a big target. All-time highs are 1570. I don't think we get over 1570, so upside to me seems limited over the next few months.
All right, well, there you have it. So as Mark said, short term, very short term, 3 to 5 days bullish, but long term, a little bit cautious, so be careful out there. That's Mark Newton, and I'm Deborah Borchardt with The Street.